going to talk about property transactions. So we need to revisit what we discussed just briefly as it relates to direct and indirect costs. So a cost, remember we talked about cost classification and cost behavior. Cost behavior, for example, is fixed cost, variable cost. Those are examples of cost behavior. Fixed costs, we said, are costs that don't vary with the production volume. So whether you make 1 unit or 10 million units, the total fixed cost is going to be unchanged. Now, variable costs are costs that vary with the production volume. So in other words, the more units we make, the greater the total variable cost. But we also looked at product cost and period cost. Remember we said that product costs are what we describe as manufacturing costs, and period costs are what we classify as non-manufacturing costs. So product costs, we said, are part of cost of goods sold, and period costs are part of SG&A, selling, general, and administrative. Those expenses are very important because they're line items on the income statement. But before we get to the income statement, before we can prepare that financial statement, we need to understand what our costs are. So from our sales, we're going to subtract the cost of goods sold to determine our gross margin. So the question is, of course, well, what are our costs? And it's not so easy to determine. One of the issues involves the difference between direct costs and indirect costs. Direct costs are those costs that we could easily trace to the production of the product. That's a direct cost. So we know, for example, a direct cost is a situation where we know how much plastic we use to make the product. Let's say how many ounces. So we know that to make a particular product, we use 1 ounce. If we make 1 million units, then we used 1 million ounces of plastic. But what about a situation where we can't easily trace the cost back to a particular product? Like an example of an indirect cost would be the cost that we pay the plant manager. Certainly, that's a product cost. Do you agree? It's not a period cost. Period costs are costs that we incur after the product is made. So part of the production process, we're going to incur costs. One of the costs is we need to have a plant manager. So we hired Gershwin. Gershwin is our plant manager, and we paid Gershwin, you ready for this, Alicia? $250,000 a year. You all right with that, Gershwin?
Yeah, I'm good.
All right, he's good. You don't want to renegotiate?
No, I'm good.
Okay, $250,000 a year. Now, our challenge as accountants is to determine how do we allocate that to the products that are produced in the manufacturing facility. So we produce a variety of products. We have, in our product line, we have a couple of dozen different items. So a product line is made up of items. So you have a group of items. Let's say you have 20 items. Then that's your product line for a particular category. We know that we're paying Gershwin $250,000, but it's an indirect cost. It's still a cost. It's still a product cost, but it's an indirect cost because really, how are we going to determine, and is there an easy way for us to determine how much of Gershwin's time is spent on product A, on product B, on product C, on product D. So let's say in that manufacturing facility, let's say it's a Procter & Gamble manufacturing facility that Gershwin is the plant manager for. In that manufacturing facility, we make Scope, we make Tide, we make Charmin, we make Ivory, we make all these products. So those products, for each of those products, we need to determine what is the cost of goods. We need to figure out how much does it cost us to make a 24-ounce bottle of Scope? Or how much does it cost us to make a 100-ounce container of Tide laundry detergent? Now, part of our cost comes from Gershwin's salary. That would be an example of an indirect cost, because we can't easily trace that back to each one of those products. Now, we're going to still allocate his salary. It's not that we're not going to take that into account. We are, but it's an indirect cost, because we can't. It's really problematic to try and trace that back to each of those particular products. Now, in other cases, we have, let's say, the cost of the laborers, the people that operate the equipment. Well, that's not an indirect cost, even though it's a wage, even though we're paying a wage, but we have a pretty good idea how many hours a week Alicia's working, how many hours a week Sharon is working. We know that Alicia is assigned to the Scope product line, so we know that she works 8 hours a week on that, operating that equipment. We know that Omar works on the assembly line for Tide. He operates that equipment. We know how many hours a week he works, so we could, it's reasonable to say that that's a type of direct cost. Now, as it relates to property transactions, we also need to think about whether or not the costs that we incur are costs that we could expense or that we depreciate. So let's say, for example, we're going to operate a business, right? We all work together, we operate this business, and we decide that we're going to build an apartment building. Sounds like a good idea? Yeah. Let's do that. We're going to build this apartment building. Now, one of the things that we found out is that in order to do that, we're going to need some equipment. And the equipment is very expensive. So we're going to need, for example, bulldozers. This equipment, let's say for our project, is $500,000 if we were to buy it. So we would need to buy several bulldozers. And each one would cost $500,000. And there's some other equipment. What other type of equipment would we need? What do you think? So we have some bulldozers and some cranes. So the cranes are also very expensive. Let's say that the cranes are $1 million each. And we're going to have 2 cranes. So now how much are we talking about right there alone? $2 million for the cranes, $1.5 million for the bulldozers. So guess what? Tamara cuts the deal for us. Tamara says, wait, coach, we don't need to buy that equipment. I arranged a deal for us. This is what we're going to do. We're going to rent the bulldozers. Tamara's got a contact, and we're going to be able to rent the bulldozers and the cranes for our project. So let's say that the bulldozers we're able to rent for $25,000 each. And how many of them did we say we needed? 3. And we also need the cranes. Sharon said we need the cranes. And so those we're going to rent for $50,000 each. That's $225,000, what we're going to pay to rent the equipment. Now, we're going to need the equipment for 2 years. So, for year 1, the rent is $225,000. And for year 2, the rent is also $225,000. So that means that the rent that we're going to pay for the equipment is $450,000. So it makes sense to rent the equipment, right? Do you agree? Otherwise, we would need, what did we say, like $2.5 million? Here, we don't need $2.5 million. We only need about $500,000. So now, that being said, I have a question for you. This rent that we paid, let's say that this is going to be in 2014 and this is going to be in 2015. How much of that rent that we paid are we going to deduct from our income in 2014? So we're operating a business. We're going to also build this apartment building. We have rent that we're paying for this equipment. But we also have income from our operations. So we also have operations, we have income. How much of that $225,000 that we pay in 2014 are we going to be able to deduct from our income? Now, maybe we should take a step back. Is that a direct cost or indirect cost? Or does it matter? What do you think? Right, it's a direct cost, but if it was an indirect cost, in this case it wouldn't matter. Because the IRS code says what? What does the IRS code say about property transactions that involve paying rent, like we described here, for equipment? So what the...
Shouldn't be capitalized.
Should it or shouldn't it?
Shouldn't.
So you shouldn't capitalize it?
No.
All right, and so we have, basically we have 2 choices. Either we're going to expense it or we're going to capitalize it. So if we capitalize it, that means that we're going to depreciate the amount that we paid for rent. So in this situation, what the Internal Revenue Code says is that for indirect or direct costs that we incur, to build this property, right, in the course of our business, to build this apartment building that we're gonna rent, right? So the nature of our business is that we're gonna be an investor in real estate. So we have other properties, we have income. Now we embarked on this project, and now's probably a good time, right, in the economy. Probably we have a better chance of getting financing, but also renting luxury condos. That's what you want to do, right, Alicia? Tamara, it's got to be bling bling, right? So we can have granite countertops. So the question is, how are we going to treat the rent, being the rent that we pay for the equipment? So the IRS code, right, the IRC, the Internal Revenue Code, says that rent that we pay as part of this project, right, which is what? A project that's going to involve developing property, so in the course of our business, should be depreciated. So in 2014, we're not going to be able to deduct any of that rent that we paid for the equipment. Instead, what we're going to do is capitalize that expense and depreciate the money that we paid for the rent. So do we follow the scenario? We have a business. We decide we're going to build an apartment building. We're renting this equipment because Tamara found this way for us to get a good deal. So we're not buying the equipment, but we're using this equipment to build an apartment building. So we have an expense. Agreed? We have this expense, $225,000, that we're paying to rent this equipment that we're using in the course of our business to develop this piece of property. The IRS says that that rent that we paid, we can't expense that. We're not going to be able to expense that. We're not going to be able to deduct that from our income in 2014. 2014. 2014 is the year that we incur the expense that so the year that we have to pay to rent the equipment.
Question. So we don't own the equipment, right? But the expense is going to bring down our net income. Is that correct? Is that how we get a benefit from it? We're expensing it on the books?
Well,
Because I'm just trying
if we were going to expense it, what would happen? We would just, let's say our income was $1,225,000. Then what we would do if we were going to expense it, we would just reduce our income by the $225,000, and then our income would be $1 million. Now, that's what we would want, right?
Yeah.
That sounds favorable to us as a taxpayer. But the IRS says, we thought about this. We thought about this quite a bit. This is what we want you to do. For rent, right? For rent, monies that you pay to rent equipment in the course of your business to build this apartment complex, you're going to depreciate that. So what that means is, like, so for example, if we use the straight line method of depreciation, that means that for each year going forward, there's a certain amount that we could expense.
Right. I guess it's throwing me off because I think of straight lining when I think of rental income from a tenant. So I think that's what it's kind of,
Mhm.
you know, I'm getting confused with, because I do
Oh, I
straight
see.
line. Yeah. Okay.
So you're right that we have a choice in our mind, right? From an accounting perspective, we could either expense it, which means that basically we just subtract the entire amount of the expense that we paid to rent the equipment from the year that we rented it. That would be, theoretically one option. And the other is that we'll have to depreciate an amount that's smaller than the total over a certain period of time. So maybe it's going to be $50,000 a year that we're going to depreciate over a given number of years.
So what determines the number?
Yeah, the useful
Wouldn't it
life.
be
How
the
do-
life
how
of
do you
the
determine
contract?
useful life?
The useful life
Because
of
it's
the
a
building,
building,
right?
it's a building.
Or the useful life,
Because you depreciate, you have to pick like a certain amount of years, right? Like the useful life of the machine.
Right. So, what do you think about would be the useful life for the equipment?
2 years.
So Gertrude is saying, how are we going to determine that?
5 years?
2 years.
this would be the life of the contract.
I guess, whatever the,
So we have to determine. We'll have to determine what is the useful life of this equipment, of the cranes and the
For us, the useful life.
bulldozers. But you see, remember we always go back to what's the intent? What is Congress's intent? Congress is saying, we don't want you, we see where you're going, but we want you to have more skin in the game. We want you to have a more long-term perspective about your venture.
So I'm
So-
looking at it from an accounting point of view, because it would be the life of the contract, because you only have it for 2 years or 5 years, how many years it is. So then you depreciate it over that period of time. But I guess that's not what,
Well, it could be. I'm not. We're really not
there.
getting into that level of detail. That's a little bit beyond our scenario. But so what's the key takeaway? The key takeaway is that for rent, money that we pay to use equipment in the course of our business to develop property has to be depreciated. But then that's a whole other, we could like keep going on. Well, then how do we depreciate it? Right? So we're not going to go there at this moment. So are we clear on that? All right. Now, let's say that this business that I created, let's say that Tamara, Tamara works for the company. She's the one who negotiated this contract to get the equipment for us, right? So that we could rent the bulldozers instead of buying them. Let's say that Tamara has intimate details about the cost of this operation. So Tamara says, Coach, you've always been good to us, and I want to give you a loan. I'm going to lend you $50,000 so that you're going to have enough working capital to go forward with this venture. So, how could I say no, right? So, I take Tamara's $50,000, right? Wouldn't you? So, I take the $50,000 and I tell Tamara, I said, it is a business. We're incorporated. We're a subchapter S organization. As the president of the company, I think it's fair. I mean, I know that you trust me, but you would trust me a lot more if I signed a promissory note that said I was going to pay you back the money, right? Wow, no trust. So we draw up this note, and it says that the company, right, I signed a note as the president, the company owes Tamara $50,000. Now, what happens if 5 years down the road, Tamara still hasn't gotten back her money, and as crazy as it is, right, the business goes bankrupt? Yeah. Sorry. These things happen. Are you upset? $50,000. It could be. It could be worse. I got $250,000 from Gershwin. You know what they say. So, yeah, so the business went bankrupt. So, what we need to decide is how that $50,000 is going to be treated by Tamara. So in other words, can Tamara take that $50,000 as a capital loss? Because keep in mind, what's one of the determining factors? Well, one of them is that it's not Tamara's business, right? So this is not a business that's operated by Tamara. It's a corporation. She works there. It's just a loan that she made to the company. So in this case, we would classify that as a non-business bad debt from Tamara's perspective. From the corporation's perspective, of course, we're a corporation, we operate a business, the company went bankrupt. But Tamara was merely an investor. She worked for the company, she had invested some money in the company, $50,000. It's not everything that she had in savings. She still got a lot more, but she still wants to sue, but maybe we could settle out of court somehow. So, that $50,000 that Tamara lost is going to be classified as a non-business bad debt for Tamara. So you might think, well, why do we need to make that distinction? Because Tamara doesn't have the subchapter S corporation. Right? So we're not, Tamara is not the owner of the company. She works there. And she loaned the company some money. So the question is, can Tamara take that as a capital loss? Since it is a non-business bad debt. So it's not in the course of Tamara's running this business, right? So the answer is, yeah, she would be able to take the $50,000 as a loss.
Professor, it won't be limited to for a capital gain?
Well, if she has capital gains, we didn't say that she did. We just said that she made the mistake of investing in my business. So she loaned the company $50,000, and the company went bankrupt. So, yeah, we're going to talk about if there was any capital gain, but because it's a non-business bad debt for Tamara, she's going to be able to write off that $50,000. But you still might want to sue. But maybe we'll work something out. So did everybody follow what happened? Tamara had loaned the company money, but that loan, that debt became worthless. Right? What could you do with it? You can't factor it. In other words, you can't sell it to somebody else because everybody knows the company went bankrupt. You're not going to be able to recover the money. So when that happens, when a non-business debt becomes worthless, then the Internal Revenue Code says that Tamara would be able to take that $50,000 as a short-term capital loss. What Muhammad is saying is that, well, what if she had gains? Well, yeah, if she had gains, then that would offset.
Actually, that wasn't my comment, because I remember, I could be mistaken, that you can't take capital loss, exceed, your capital loss, you can only claim for capital loss, as, to offset your capital gain, basically. Is that, so that's not,
So you don't think that she's entitled to take the capital loss?
but she won't be able to claim that loss if she doesn't have that capital. She can only claim that capital loss, to the extent of capital gain.
So what about if she, in this case, she doesn't have any capital gains? What do you think?
Then she can't. I may be mistaken, because I remember, that's what I remember reading. I could have completely misunderstood what I read, but that's why I asked that question.
Yeah. In this case, she's gonna be able to take the $50,000 in the short-term capital loss. But we're gonna, in a minute, we're gonna talk about this calculation, which is really what Muhammad is alluding to, is that, well, he's saying that, how do we determine the net long-term gain or the net short-term capital gain? So what Muhammad is saying is that, well, we know that she has $50,000 as a short-term capital loss. Well, if she has capital gains, we need to add those two together to get the net short-term capital gain. Why is that so important to make that distinction? Because the net long-term capital gain is taxed at 28%. Then we're going to talk in a minute about, and this is zero. So short-term capital gain is taxed at a rate of 0%. Well, we're going to look at an example in a minute, and we're going to do some calculations to determine what is the capital gain net income, which is what? The capital gain net income is when we add these two, the net long-term capital gain with the net short-term capital gain. What does that give us? That's going to give us the capital gain net income. So what we're doing really is we're taking the net long-term gain and adding it with the net short-term gain. See, we've already done this computation to find out what is our capital gain net income. That's what we do on Schedule D. So we're going to indicate, we're going to list the, let's say, whatever it is that we sold, the stocks, for example. We're going to list the stocks that we sold. We'll have to determine what is the cost basis for those securities. So to determine whether or not there was a gain or a loss for both long-term and short-term securities. So we know, so our broker is going to tell us what the proceeds are from a sale. So let's say we sell 1,000 shares of a stock. We know what the proceeds are, which is what? The number of shares times the price that we sold it at, minus the commission. That's going to be the proceeds. Well, we need to know, to find out if we made money, if we had a gain or a loss, we need to know how much we paid for those securities. We know that we sold 1,000 shares. Well, how much did we pay for each one of those shares? So that's the cost basis. We need to know what the cost basis is. And that's, the cost basis is required on Schedule D, so we need to indicate what our cost basis is. So it could be, let's say, $30,200, and we sold it for $42,800. So the difference is our gain or loss. In this case, sounds like we made like about $12,000 something roughly, right? But after we determine the net long-term capital gain and the net short-term capital gain, we're gonna get this. So ultimately, that's how much we made. So whether we're short-term or long-term, the capital gain net income is already taking that into account. So I want to know, at the end of the day, what happened? Did we make money? We sold stocks, sold a variety of stocks. Some we sold at a loss, some we sold at a gain, some were short-term, some were long-term. And then what? We're all sitting there thinking, well, what happened? Some of them we made 12,000, some of them we lost 6,000, some of them we made 20,000, some of them we lost 3,000. So we'll have to calculate the capital gain net income. All right, so the next thing that we need to look at is capital assets. What is included as a capital asset by the Internal Revenue Code, and what's excluded. So let's say, for example, we decide now that there's another lot that we're going to buy, another piece of property that we're going to buy. And why do we buy this lot? Well, our vision that Corinne advocated for was that lot we're going to use so that our customers, our guests, can park there. So that lot we bought for $150,000. At the same time, what we did was we decided that we needed to renovate. So one of the things that an interior decorator had given us some input on is lighting. The interior decorator said, Tanya, you need to tell the boss man that we're going to need to change the mood of this location, of our store. And what I think you need to do is you need to buy, and I'm going to recommend for you, some lighting fixtures. And that's going to cost us $25,000. Yes, you want to work with interior designing? It's going to cost you a lot of money. This is not, one of these light fixtures that you buy at Home Depot for $5.99, right? It's going to be really impressive. So being that we did that, the question is, are those capital assets? So we bought a lot that we're going to use for parking. And we also bought these lighting fixtures. So what do you think? Do you think we spent too much money on the lighting fixtures? You think maybe we could have got a better deal? Maybe we should have went to Lowe's instead. But maybe we shop around a little bit. We'll send Tamara back out into the field. She got a good deal for us on those bulldozers and cranes, right? We were all ready to spend $2.5 million to buy the equipment, but Tamara, I don't know how she does it. She was able to negotiate a deal where we could rent the equipment. But we need to understand what's considered a capital asset and what's not. So my question is, what portion of those costs are considered to be capital assets? What do you think? Is the lot that we purchased for parking, is that going to be considered a capital asset? So we bought this lot because we have this store, and we realized that, on Flatbush, there's never any parking, but this lot became available next to us, and we said, you know what, we really need to have this lot. So, the IRS says that we're not confused about
I'm sorry.
what's a capital asset. And there's some exclusions. So what is the Internal Revenue Code say? It says that all capital assets, I should say capital assets are all property held by a taxpayer that's not excluded. So capital assets are all property held by a taxpayer that's not excluded. So what about the items that we just discussed? So capital assets are all property held by the taxpayers that are not excluded. Now this lot is what? How would we describe it? The lot is real property. So that's actually something that the IRS has excluded as a capital asset. So it says real property. We understand, yes, it's real property, but we're going to exclude that. And what about the fixtures? We spent a lot of money on these fixtures. We said they're not these fixtures that you're going to buy for like $5. We're talking about spending $25,000. So that's business property that we would expect to, what? Depreciate. So if you're spending $25,000 on fixtures, on light bulbs, that's something that that you would depreciate. So the Internal Revenue Code says that, well, when we think about capital assets, there's some things that we're going to include, there's some things that we're going to exclude. And the two that we just mentioned are those that are excluded. The real property. So if you're holding that lot, the taxpayer is holding that lot, that's excluded. So that can't, the IRS says that that's not considered to be a capital asset. And the fixtures, that's business property that we would expect to depreciate. That's also excluded. Now, we might disagree, but the IRS, Congress says, well, we thought about this a lot, and you might disagree, but that's what we decided. That's what it says in the tax code. That's what it says in the IRC, the Internal Revenue Code. You don't have to agree, but that's what it is. So keep that in mind in running your business, that these items in particular are excluded. Now, what about personal use property? That's included. So for example, let's say for example, we have a situation where you decide to purchase a really nice watch. Things go your way. You buy yourself a really, really nice watch for $25,000, right? So you said, you know what, I did it. I graduated Brooklyn College, and I memorized Publication 17. I got a good job now. I'm going to treat myself. So you spend $25,000 to buy a watch. Now, for $25,000, you would expect that there's some diamonds in the face of the watch. Now, what happens is, in, let's say, 10 years, you're thinking about buying another watch. So before you do, you decide, you know what, let me find out how much this watch is worth. Because, you know, the price of diamonds vary. So you find out that your watch that you paid $25,000 for is now worth $50,000. Are you excited? And so what do? So we have one person says to sell it. Another choice is we decide to give it as a gift. So you give it to your child. It doesn't need to be a qualifying child. Let's say you give it to your daughter, not your cousin. Right? You give it to your daughter or to your son. Is that a capital asset? And the answer is yes, it is. It's personal use property that's held by the taxpayer. And so in that instance, it would be considered to be a capital asset. So one of the things I'm trying to highlight for you today is what's considered to be a capital asset and what's not a capital asset. Not IMO, which means what? Right? In my opinion, not in my opinion, it's because that's what it says in Internal Revenue Code. All right, let's keep rolling. I think we'll be out of here before midnight. Why are you laughing? All right. Let's see. This you should, do you guys write this down? This is important. So what we're going to need to determine is this. What is the capital gain net income? So we have a client that comes to us and they want our expertise. Somebody told them that they needed to determine their capital gain net income. So let's see how that would come about. Let's see if we could go through some calculations. All right? Let's say that we have a long-term capital loss of $25,000. Yikes. Scary, right? Yeah. Investing. Some people call it investing, but it's really gambling, isn't it? Because how do you know? You have no way of knowing. Unless you have insider information. Oh boy, you don't want to go there, right? We talked about that. So we have this capital loss. But then, Muhammad was suggesting before that, well, that's devastating, but guess what? We also sold some securities, and we actually had a capital gain. In fact, our capital gain, our long-term capital gain is $100,000. So as Muhammad suggested, we have a loss. We also have a gain. So what we do is we use that information to determine the net long-term capital gain. So in this case, what is the net long-term capital gain going to be? How much? 75,000. So, not too bad. right? Not too bad for the year. Tanya, you're excited, right? Let's see, let's see if we're on a good streak or what. Then we find out that we also had some short-term capital losses. So now Omar is getting worried again. He says, I don't know, I don't have the stomach for this. I don't like losing money. So, as it turns out, that our short-term capital loss, in this case, let's say we didn't have to hold the stock for very long. Let's say in this scenario, we hold it for 9 months. How much was our loss? $5,000. But we also had some securities that we also had for less than a year, let's say about 11 months, and our short-term capital gain was $20,000. So then is our net income, is it a gain or a loss? Something? What's thinking? So our loss was 5,000. Our short-term capital gain was 20,000. That means our net, the net short-term capital gain is $15,000. That means our net income, our capital gain net income is $90,000. Now, there's going to be a number of questions that you're going to have to answer about a scenario like this. So you need to make sure that you answer the question that's being asked. So in other words, capital gain net income is not the same as net long-term capital gain. So read the question carefully to make sure that you're answering the right question. Or let's say I didn't give you this. Maybe I just told you that. So that doesn't change anything. Maybe I just gave you this information, this, and this. So don't panic. We know still the same methodology applies. We know that the net short-term and long-term capital gain has got to be added together. So we do this first to get the net long-term capital gain. And this I told you, so you don't have to do any computation. And then
That's how much your tax now.
the capital gain net income is $90,000. So the question might be, if I give you some data like this, how much is the capital gain net income? So you're going to have to compute that based on the information that's given. So I'm going to give you some summary information like that. At this point, we're not going to do the Schedule D, but we will. I have a couple of scenarios I want to work through with you to prepare an entire 1040 return. So what I'll do is I'll upload it to Blackboard for you. All right, so it's going to be a scenario that's going to involve itemized deductions, that's going to involve dividend income and interest, and capital gains and losses, and also Schedule E, which is for rental property. But that's going to be a good way for us to pull together all the pieces. We'll go over that in class. But for right now, what I want us to focus on is, how do we determine the capital gain net income? So are you going to be able to do that? Yes, you can do it.
I have a question. So you just mentioned the fact that, let's say you give us the detail of the long-term gain loss difference, and then the short-term you just said 15. We don't need to be thinking about what the amounts are for the loss and the gain. We just need to know what's the,
Right, because I'm already telling you the net.
Yeah.
I told you the net.
yeah. So we just need to.
Now,
calculate
I
that
might have told
for
you this, and then you have to compute that.
compute. Oh, okay,
But in this case, I told you what the net short-term capital gain is.
okay.
So the question would be, what is the capital gain net income?
So that's what it is.
Right, in this case, it's how much? 90,000, right?
Yeah.
Yes.
All right, moving right along. Oh, this is interesting. How about this situation? What if, besides lighting, what if we actually purchased, let's say, some merchandisers? You know what a merchandisers are? Merchandisers, you know, are used to display products that we're going to sell. And let's say that we spent $100,000 on that. So we spent $100,000 on this. We could call it furniture. If you want to call it furniture, let's say it's like an office furniture. We spent $100,000 for this furniture. Now, we decide that we're going to sell the furniture. And things are going our way. It turns out that we are able to sell the furniture, right, these merchandisers, for $120,000. So let's say what we got here. We buy the office furniture for $100,000. And we sell it, we're able to sell it because we bought good quality equipment, furniture. We were able to sell it for $120,000. Why? Because one of the reasons is that who does all our buying for us? Tamara. So Tamara got us a good deal, and we're able to purchase this office furniture for $100,000. And then we were able to sell it for $120,000. All right, so how much is our gain? So in this example, we're going to say our gain is $20,000. We buy it at $100,000. We sell it for $120,000. We're not going to. For now, we're going to assume that there's no other expenses, like for shipping or anything like that. Let's just keep it simple. But now, this $100,000. This $100,000. What did we do when we purchased that? What we ended up doing when we purchased that furniture for $100,000 was we depreciated it. We didn't expense it. We didn't take it as an expense. We depreciated it. So let's say that we depreciated the furniture using straight line depreciation, and what do you want to say? The useful life is 5 years? Okay. So 5 years. So that's $20,000 per year. And now, this is in year 3 that we're going to sell the furniture. So $20,000 in year 1, $20,000 in year 2, 20,000 year 3. So the amount that we depreciated is $60,000. Now, the question is, what part of that would we consider to be a long-term capital gain? How much would be the amount of the long-term capital gain?
60.
What does section 1245 tell us about a situation like this?
So they have back the depreciation, right?
So section 1245 tells us that property that we depreciated we would take the lesser, okay? We would take the lesser of the amount that we depreciated or the gain realized. So, which portion is the long-term capital gain? What are we going to say is our long-term capital gain? Is it 20,000 or 60,000? Section 1245 says that this type of depreciable property, we would take the lesser of the two, the lesser of the depreciation. So the depreciation is 60,000. And the gain is 20,000. So we take the lesser. In this case, the lesser of the two is going to be the $20,000 gained on the sale. So the lesser of the gain realized and the depreciation. So it's going to be the $20,000. It's not IMO. That's what the code says. All right, let's take another situation. So that was the watch example. We talked about the watch. We gave it to our son, daughter, right? And yeah, that would be considered to be a capital asset because it's not excluded. The IRS excludes some type of property and includes other types of property. And the watch is an example of personal property, personal use property. It's warm in here, isn't it? So let's say we're on this selling spree. We're deciding we're selling. We did so well, right, Tamara? We sold the office furniture. Let's see what happens if we sell some other business assets. What would happen if we sell some other business assets, but let's say there was a loss. So let's say we decide to sell our business and there's a loss on the office equipment. So we're going to abandon our office equipment. We're not going to take it with us. There's a loss. Let's say the loss is $150,000. let's see, what did we say? $120,000. And let's say that we also have the loss on a building, right? So we have our office furniture. We have a loss on the office furniture for $120,000. We also have the loss on the building, which is $900,000. $120,000, $900,000 on the building. And let's say that the building, we've already depreciated $500,000. And we also had some delivery trucks that we also had a loss on. Let's say that was $200,000. So what do we have here? So who could tell us what our losses are? For which items? What do we got? What's the $120,000 for? We lost $120,000 on the abandonment of our office equipment. Office furniture, sorry. And what is the $900,000? For the building, and then $200,000?
Delivery truck.
Right, the delivery trucks. Yeah, things are not going our way all of a sudden. It's all because of that loan, that $50,000 loan from Tamara. So now so having said that, what is our total loss at this point? How much is our loss? Okay. So we know this is a loss, this is a loss, this is a loss. What do you think?
You don't have to take away the depreciation, right?
Yeah, tell us, Corinne.
If you take
So
away-
what do we do with the depreciation?
You take it away from the 900.
So we have 900,000. Should we take away the depreciation or should we add the depreciation? What do you guys think? So we said we already depreciated in prior years 500,000.
We added it.
So should we add it back?
Yes.
What do you think? Is that part of the loss?
Just for ordinary income.
Yeah, we should add back the 500,000. So how much is that? Is it 1720? What is important to note about depreciation? What is it about depreciation that's different from other items on the income statement? What is it that makes depreciation unique relative to any of the, whether it's the cost of goods sold, advertising, All right, so I hear something, you're close. What, go ahead, tell me.
You have to look at the previous year to determine this year's depreciation.
But relative to other items on the income statement. So Camilla is saying, well, how do we determine it? Let's not go there yet. Let's just figure out, let's think about what makes depreciation unique relative to the money that we spend for advertising, the money that we spend for Gershwin's salary of $250,000, the money that we paid for electricity, the money that we paid our sales force, their salaries, the commission that we paid them.
That's the value that's lost, or that's the amount that has been used up.
Depreciation is the down value of the capital properties like machinery things. Where is the use going down value of that?
But, so that being said, let's go back to our example here in, let's see. No, we didn't do that here. Let's see, where do we do the, which one did we do this? Let's see. Oh, here. So,
Like we bought the car this year, after 3 years it's gonna be price is down, but due to the depreciation of that capital.
right, so, okay, so in this case, we said that we used a straight line depreciation method. We said the useful life is 5 years, so we depreciated $20,000 per year for 5 years. But, what? What is it that, when we show depreciation on the income statement, why does that deserve special attention? Why is that different from those other costs that we incurred?
Because the other costs are actual in the sense that it's a value that changes compared to depreciation is just on the books.
So, yeah, and so to paraphrase, what I'm hearing here is that depreciation is a non-cash transaction. So in year 2, in year 3, in year 4, we keep taking off this $20,000. We say it's depreciated, but did we take money from any place? Did we like have to write a check? Did we take cash out? It deserves important note because it's a non-cash transaction. So this 1720 would be we would classify that as section 1231 property. So in this case, the property could be, this is the furniture. So is it real or depreciable? Yes. So that's the furniture. The building, real or depreciable? Yes. And then our trucks, real or depreciable. So the question is, would these items be classified as section 1240, section 1231? In this case, it's property that we've had for more than a year, and it's either real or depreciable in the amount of, well, this is $1,720,000. So one of the things that we need to be able to do is to look at different types of property and determine which part of the code is going to apply. One of the questions on the exam was about, well, how does the CPA do this? Do they look at relevant information, irrelevant information, factual or unfactual? Well, you need to look at the facts, and then that has to be examined within the context of the tax code. So that's what we're trying to establish here, is determine what type of property is this? How are we going to deal with this situation where we're forced to sell these assets? And that being said, we have some losses. So we experience some losses. The question is, how are we going to classify them, and what is the amount of the loss? Do a little bit of a review. All right, let's take a couple of minutes, and we're going to review some key topics here. And we're also going to look at all right, so who could tell me in 2012 what is the amount of the personal exemption? So for the federal income tax, what is the amount of the personal exemption? 3,800. 3,800. All right. Now, remember we talked about qualifying child? So, what would be examples of qualifying child? Yeah, so your son, your daughter, your stepson, stepdaughter, foster child, and importantly, we made a distinction about cousin. We said that your cousin is not a qualifying child. Now, as related to the qualifying child, we said that one of the tests is age. So we need to look at the age of the qualifying child. Now, actually, there's two different ages that are under consideration. One is the child would be, to meet the test, would be less than 19 years of age, or less than 24 if they're a full-time student. So it's got to be, you got to address both of those. So it can be, for a qualifying child, it can't just be the answer that looks familiar. Okay, so sure, I know when you saw that, you said, oh, yeah, less than 19. But, and you recognize that, but what the code says is that a qualifying child could be either less than 19 years old, or they could be less than 24, right? They could be 23 if they're a full-time student.
But first, in a way, that's not a very fair question, because the portion that's given, that's true. That part is true. The other part is missing, doesn't make that part wrong.
Right.
You know, that's why majority of the people probably chose true.
No,
And-
they didn't actually.
Really.
Yep. And so that's, if you guys are really serious about taking the CPA, I can tell you from personal experience, a lot of questions are that way. So in terms of test-taking tip, there's always going to be answers that look familiar to you. Of course, I know when you saw it thinking, yeah, that's it. But what's the other part? That's not what it says in the tax code. There's more. It says that, well, but if they're a full-time student. So what about that? So you gotta keep that in mind. It's not just, it says a qualifying child must be less than 19 years of age to meet the age test.
But it's
But
true.
that's true. It said a qualifying child must be less than 19 years of age. No, they don't need to be less than 19.
But they should
They
have
could
added
be-
that other part with 24.
They could be 23. Right? They don't need to be less than 19.
So Professor, what would have made that,
Yes.
what would have made that true?
Well, if
They
you said, if you
added-
included both,
They
you
just had
said,
that information now, without the 24.
Yeah.
Like, what kind of information would you put to make that true? See, I should say may, must, like, what word would you have to change? May? He may?
well, I mean, it says must, so
That's what
must.
I'm saying, so you, if you said may, then,
Well, I mean, it's not,
you understand what I'm saying?
no, not really. I mean, I'm not gonna, what I wanna try and do is to review with you the concept. I'm not gonna debate with you,
No, I'm not debating.
the format of the exam. I mean, after all, I mean, you're graduate students, and it's a multiple choice exam, right? I mean, that's, I just wanna make sure that you understand that that's not the only criteria. So the code is very clear. The code says that the qualifying child, in terms of the age test, could be, and we went over this in class, so I think, I hope that was, that had an impact, but it's not just, the code says that they could be less than 24, they could be 23 if they're a full-time student. Think about if you had a client that you were giving advice to. What would you tell them? So if the client came to you, what would you tell them? If you're a qualifying child, right, you say, well, I don't know, do I have a qualifying child? You have to tell them. What are you going to tell them? You're just going to tell them, oh, qualifying child must be less than 19 years of age.
Or
But, so, I mean, how could you only tell them that, well, then, so did you tell them the right, did you give them the right opinion if you told them that you must be, your qualifying child must be less than 19 years of age? Then we didn't give them the correct information. Because if the student is a full-time student, I mean, their child, I mean, if their child is a full-time student, then like you said, then they could be 23.
No, in this case, it would be more like, if somebody came and asked, my child is less than 19 years old, is he qualified as a special child?
Right.
We would say yes. And I think this is the question on the exam was like that. The question was, I mean,
Could that
It's
be
true.
true?
It's
And I'm
true.
like, yeah, it's true, because it could be true.
Yeah.
Well, then,
It's a losing battle.
definitely
It's a losing battle.
it's a losing battle because it's not, like I said before, it's not my opinion. It's what does the tax code say? So the tax code is very clear. So sometimes the tax code says either, sometimes it says or, sometimes it says and. So in this case, we would be giving the client the wrong information if we told them that your child needs to be less than 19 years of age. That's bad. We didn't give them the right advice. Yeah. But if you are planning to take the CPA, brace yourself because there's a lot of questions like that. It's always the other part. Or, and we always gravitate towards the familiar answer. Like, oh, I recognize that, but what about the other part?
Professor, we knew about the second part too. It's just that you know what? I was first gonna choose false, but then I was like, you know what? This part is true. Let me just change it to true. Let me just stick with true. It's not the fact that okay, just that part was familiar. I knew about the second part too. It's just that I don't know. It was hard to decide. It was better 5 points. So.
All right, so now I'm as your coach, so I'm even though it's kind of late in the game, as a grad student, to get coaching on taking multiple choice exams, I'm glad to do it. I'm glad to do it. And like I said, if you're going to take the CPA, you're going to see a lot of questions like that. That's so typical. Keep that in mind. And by the way, we talked about that in class too. So I think it's reasonable. All right, but what about this other question about what's considered to be income? Remember, I took the time, we went through every line of the 1040. We talked about wages. Remember, Janelle? We talked about wages, we talked about salary, we talked about farm income, all these different types of income. So that there shouldn't be any confusion as to what is income and what's not income. So, very important part of the IRS code. And then, so we have business income, we have farm income, yes. We have construction income. And what is that, construction income? I've never heard of that before. Construction income? What? From construction? We went through every line in the 1040. Income. What's the first section? Income. Dumped it up, went through all of those lines. Construction income, I have no idea what that is, but I know what business income is. What's that? Schedule C. We have farm income. Remember we talked about in class? We said we used to really be an agricultural society. The U.S. used to produce a tremendous amount of agriculture, and we still do, but really we're more of a service economy. Even though we do produce a significant amount of food for the world, farmers get subsidies, something that Congress is very aware of and is interested in monitoring. So construction income is not a type of income, but taxable refunds are, and we talked about that in class. So one of the questions was, remember we went through this scenario in class? What happens if in 2011 you have withholding from your check of $15,000 for New York State and local income tax? So when you prepare in 2012, you're preparing your 2011 return, right? You decide that you're going to itemize your deductions. So why are we able to do that? Because one of the things that we can deduct is taxes paid. So state and local taxes is one of the lines. We paid $15,000. Is that a lie? It is a lie? We paid $15,000. They took it out of our check. It was a withholding. We paid $15,000 to New York State. We're not, that's the absolute truth. We paid $15,000. But in 2012, when we were preparing our return for 2011, what happened? Well, we prepared our federal return, and we also prepared our state return. So our federal return, we're quick to put down $15,000 for state and local taxes paid. But then we also have other deductions. Like, for example, medical and dental, that's the first, and we're going to talk about that. We also have a significant amount of mortgage interest. So our mortgage interest is $42,000 a year. The tax code says, well, that's something that we could deduct. And we also pay property tax. Our property tax is $18,000 a year. So when we prepare our state return, we have a significant amount of deductions. We have $42,000 for our mortgage interest. We have $18,000 in property tax. The $15,000, obviously we can't take that off on our New York State return. So what happens? because we've had such a significant amount of money that we spent on mortgage interest and property tax, it turns out that after we file our state return, that we're going to get a refund. Are you excited? We're going to get a refund. They held $15,000 out of our check. Every week there was a withholding, and they held $15,000. And we filed our return in 2012. In fact, we're so eager that we literally, January 31st, we're filing our tax return because we have a feeling that we're going to get a refund. And sure enough, like 8 weeks later, New York State Department of Finance sends us a check for $10,000. Or maybe we did direct deposit. $10,000. Now, that creates an interesting dilemma for us, because we already told the federal government that we paid New York State $15,000 in state and local tax. Now, at the time that you prepared your federal tax return, that was true. You had paid $15,000. Even you did your state return the same day, and you know that you're getting a refund. You didn't get the refund yet. You paid them $15,000. The next year, they send you a refund of $10,000. So that means that we need to claim that as income. That $10,000 refund that we got from New York State is income. And there's a line item known as taxable refunds. So business income, farm income, taxable refunds, those are all forms of income. Construction income, if any of you guys can figure out what that is, you let me know. But now, when we do our 2012 return, we're going to have to report that we had income of $10,000 from New York State. And where do we put that? On the item for taxable refunds. Do you see why we need to report that as income in the following year, now that we got the refund? Because what did we do when we reported that, when we took that $15,000 as an itemized deduction, what did it do? It reduced our taxable income. That means we paid less in tax. We paid less tax in 2011 on our federal return because we took that $15,000 deduction. But now we got a $10,000 refund, so now we got to add it back for that year in which we received it. You make $100,000 a year, and you have some medical expenses. You have these medical expenses, and your insurance company, right, your medical expenses are $10,000. So you get a bill from Kings County Hospital for $10,000. Your insurance company paid $5,000. You paid also $5,000. Tamara has the check paid. They believe Tamara that she paid the $5,000, but they're going to believe her a lot more if she has that check for $5,000. But the Congress says that there's a floor. What is the floor? That means that the first 7.5% of your income, you're going to be out of pocket. So for us, based on our income, $100,000, that means that 7.5%, the first 7.5% of our income, we are responsible for paying as it relates to medical and dental expenses. So that means that we have to pay $7,500. Once it's more than $7,500, the IRS says, well, now we can talk about how much you're going to be able to deduct. But it says if you paid $7,500, then that's you paid what you should have paid. We're not going to allow you to deduct unless it was, in your case, because remember, it's 7.5% of AGI. So our AGI is $100,000. We only pay $5,000. So how much can we deduct? Can we deduct $10,000? No, because we didn't pay $10,000. We paid $5,000 and our insurance company paid $5,000. Okay, so that seems to be clear. And then, what about the $5,000? We did pay $5,000. You sure you have the check? Right? Tamara says she swears she has the check, a dental check for $5,000. Said, all right, the $5,000 they're going to deduct. Nope. We're not going to be able to deduct the $5,000 either because it has to be more than $7,500. Why? Because the floor is 7.5% of our AGI. For us, it's $100,000. If we were making $50,000, then 7.5% would be $3,750.
So I was so mad I couldn't change the answer. After sent that answer, I realized I did the wrong answer.
You had an epiphany, right?
Change it.
You had an epiphany. A moment of truth. So if our income was $50,000 instead of $100,000, would we be able to, how much would we be able to deduct? So if our adjusted gross income was $50,000 instead of $100,000, how much in this scenario would we be able to deduct?
I think it's half of the
Is that you, Gershwin? Go ahead, say it.
$12.50.
$12.50. Why? Because the first $3,750 is our responsibility. That's the 7.5%. We paid actually $5,000, so the most that we could deduct is the difference, which is the $12.50. Remember, importantly, you can't deduct medical and dental expenses that were paid by others. So if your insurance company paid it, we don't consider that. It even says on Schedule A, because that for some reason is a misconception as to how to determine the total amount of medical and dental expenses.